Okay, welcome everybody. Thanks for being with us. We're doing our quarterly webinar to talk about what's happening in the markets and our outlook. And we'll just skip through a slide or two here, just our standard compliance requirements. So information is subject to change. So we're conducting this discussion on April 24th. And let's get started. Joining me to talk about, I'm Chris Boyd, for those who don't know. Probably with us is mostly our clients. Most of you probably know who I am. Brian Regan, our portfolio manager and economic strategist, is joining me as well. And Brian will be our principal presenter today. And thanks for being with us. It's trying times, a little bit of crazy times when it comes to the world we're living in right now. And so certainly a lot of people have anxieties about, well, first and foremost, health concerns, but when it comes to their financial life, there's plenty to be focused on. And we're going to try and speak to that today. This presentation is largely about portfolio design and economic conditions. We are preparing a webinar next month for financial planning opportunities and considerations, some of the strategies that people might be interested in thinking about. For example, the idea of whether to consider doing some Roth conversion in a year when we might not have to deal with distribution requirements and things like that. So to start things off, let's look back a little bit and focus on what's happened over the last quarter. And to do that, one of the things we want to start by talking about is to recognize what we did in going into the quarter and some of the things that worked and may not have worked as well as we look back and say, how are we structured? So by and large, we were a little bit defensively positioned. And so we went into the quarter recognizing that there were some changes. There had been some trade deals. Brexit had been reached some manner of resolution. And so there was a little more optimism about what the global macro environment might be. Trade deal with China was moving forward in phase one. And so there's a reason to be a little more optimistic about what the economic picture could be. We did think that domestic stocks were a little expensive. And so we had, even prior to this, been a little more cautiously positioned. And so, that was a theme that we were attentive to, but we were feeling a little more sense of optimism because of some of these changing dynamics. That being said, we thought we would increase some international exposure, but in some of the things we had done in the US, we still remained underweight. We had, no one had anticipated the coronavirus impact on the market or the changes in the energy space, where we had seen some changes with Saudi Arabia and Russia and the way they priced oil. So these were somewhat detractors to the portfolio, but even though that's the case, because we were more defensive in our positioning, we weathered the storm pretty well going into the quarter. When it comes to some of the ways in which we were continuing our defensive position, we kind of continued that theme. And one of the things that was good for us is that although we did have a little bit more international exposure, it was still underweight stock. And the exposure we had for some of our risk on exposure was in some things that were a little more defensive in the bond positions, these bank loaned bonds. We were underweight mid cap and small cap, which was very helpful. We were overweight in healthcare, which definitely worked to our advantage. What were some of the other things? We did the opportunities to have some tax harvesting. Brian, do you want to speak to some of the other points here?
I think the only one that you missed there was we continue to be overweight in gold. We've been in that for about a year now, and it was based on the economic premise that as currency started to weaken, gold would do better. We've seen that happen even more than I thought humanly possible over the last month. So, it's been a big benefit to portfolios. So, Chris, we also, we don't normally typically do this, make mid-quarter adjustments because we like to have our theses play out throughout the quarter because we usually have pretty good conviction on them. But this quarter was an exceptional event for all the coronavirus, COVID-19 reasons that we all know. And the liquidity crisis that came about gave us some unbelievable opportunities. So in some of the more defensive portfolios, we were able to move into municipal bonds and long-dated treasuries, which all have returned 10+% in a short amount of time. And in the more aggressive portfolios, we were able to take advantage in some dramatic changes in the high yield market when we were able to enter that market for the first time in at least a year. And
you'll offer some additional insights as to what the thinking behind that is for all of those as we go through our presentation today. But it is worth that. I think I'm glad you pointed out that that's not ordinarily something we do, but when there were some great opportunities that presented themselves, it was important to be ready to act.
So here's a quick kind of layout on how we're going to present today. We're going to talk about navigating the virus, then navigating the market, and then some ongoing things that you would imagine we would have in a normal quote unquote quarterly talk that are obviously a little bit on the back burner now, but I think it's important to keep them in mind because they could move the markets a little bit. Most importantly, I think when we talk about navigating the markets, the virus, I think there's 4 distinct things that are going to happen over time. Social distancing, obviously, we're all experiencing that now, and I do this from my home office.
Same here, right? Yeah.
We're going to have mass testing. Hopefully, we're going to have some kind of antiviral treatment. And finally, we're going to have a vaccine at some point. And only time will tell when these things will happen, and I guarantee you all the data that comes through on all those things will provide dramatic changes in the market. So navigating the market, obviously we had a huge liquidity event, a huge change in economic conditions, but we also had a giant government response, which changed valuation in a way that we think about valuation in the market. And there's also, when an event like this, there's going to be cascade effects or domino effects. So that's what forward thinking is important. Try to get ahead of things, position the portfolio so we don't have to make drastic changes if something happens, that we're actually ahead of it, just like we pretty much were before this. So we're going to start navigating a virus here. We're going to go through this data pretty quickly. This is some data on curve bending, essentially. This is from Worldometer. This gets updated every day. Anybody can access it. I look at it every single morning. I think it's really important. So this is the United States. You can tell that the curve is starting to get less steep there, and our daily cases have kind of leveled out. Not ideal yet, but certainly a better trend than we were on.
And as we speak, just before we move on, as of today, there are some 869,000 confirmed cases, according to the New York Times, with about 44,500 people having been attributed to dying from coronavirus. And in Massachusetts, we presently have the 3rd most cases of all the states in the country, with about 46,000 cases, and we're probably around 4th in the amount of deaths, with about 2,360 right now. So certainly not by any means removed or resolved from this problem yet.
Italy's a couple weeks ahead of us, and you can see that they've started to bend their curve. I remember when the northern part of the country was shut down, and then soon after the entire country was shut down. I think we're a little bit, maybe a couple weeks behind them, but you can see their curve has started to bend, and their daily cases have fallen to a lower level for sure. Same thing with Spain, more similar to Italy. China, they're pretty much through it, and that's kind of where we'd like to be, ideally, right? So, a good statistic that I wrote in the investor letter this quarter was that 90% of the Starbucks in China are open, and that's not a China statistic. That's right from the former chairman, or the current chairman, former CEO's mouth himself. South Korea, they had less of a problem right from the beginning, as you can see from the daily cases, and that's because they were very proactive with their testing. And so they are through it quicker because they were, as soon as you can detect problems and trace them, the better off. So that kind of brings me to testing. The chart on the left is tests per million per population. And I think it's pretty sad that there's no, major Western countries on that list. There's kind of smaller countries that lead the way. And then on the right, we have a total number of tests. And obviously, some bigger countries are going to pull away here. But again, I think it's a little disheartening and room for improvement for the United States, where we have about 15,000 per million, where somewhere like the United Arab Emirates has almost 80,000 per million. Obviously, the next step after testing would be hopefully we get some antiviral drugs approved. We got some bad news from Gilead's remdesivir yesterday. That was the kind of leading hope, and it was leaked on the World Health Organization's website that the test that they had going on in China didn't have any conclusive evidence. There were some problems with the test though, so Gilead Science came out with a statement where they're still, bullish about it. Excuse me if I can't pronounce these. I'm not very good at it. Hydroxychloroquine has been touted by the president for sure. There hasn't been any definitive evidence that that's certainly going to work. It would be nice since it's just a pill, where Gilead's remdesivir would be an IV, so it would certainly get you into the hospital. There are some antiviral drugs approved in China and Russia. It's a Japanese drug called Valuation. Regeneron and Amgen are both working on antibody treatments. So this is, the technology where they use the plasma from people's blood to create antiviral effects in your body. And then there's other antiviral drugs from Pfizer, Roche, and many other global companies, as well as technology on testing, especially from Abbott Labs. That's notable. Vaccines is over. We spent some time talking about the virus, which has obviously been difficult, but talking about the government response is just as important. I mean, we had a $2 trillion fiscal response to the market, which the Federal Reserve can, quite frankly, use to, and businesses can use to leverage that into more investment and even more liquidity, which I think is very important. It hit everything from individuals to direct payments, through increases in unemployment benefits. There's also money there for state and local businesses. There's money for a PPP. Chris, I think you wanted to talk about that for a little bit.
Well, I just think, this was really important. It can't be understated that the economic challenges we have right now are pretty severe, with so many businesses being, required to, in the public interest for public health, being required to stop their interactions with other people and therefore being shut down. The economic consequences, by no means insignificant. It is substantial. And so the PPP has been a help to try to help mitigate some of those risks for small businesses. And, small businesses make up more than 50% of the jobs, and so in the U.S. economy. And so we saw the 370 billion get utilized very rapidly. Today, there's been an additional sum of some 484 billion added to the availability of funds to help small businesses maintain their ability to pay payroll and ultimately to have some of that as a grant. It's challenging, and I think we have, we definitely recognize, when we're going to talk a little bit about this more, but that this is not an easy time when it comes to those who are affected by this for their own jobs or their own businesses. And yet the government response, with the kind of totality of the numbers here, $2 trillion to start with, maybe closer to 2.5 now, and probably likely to grow, is meaningful as to why we think that there's some mitigation to the type of impact this might have long term, and why it might help to make it a more smooth rebound ultimately. So continue on, sorry.
So I think, I'm really happy with the way the Federal Reserve quickly and swiftly addressed the problem. They basically, so the way I would characterize what happened with the stock market, and frankly up the credit markets as well, is we had a liquidity crisis. People were reaching for cash everywhere they could. When that happens, the market can essentially go into free fall unless enough dollars are made available. And that's really what the Fed did. They took out the old playbook from 2008, 2009, and what took 2 years to happen there, they did in a month. And then they added a few more wrinkles, like the Main Street funding facility. All good things to put a floor underneath the market, and you certainly saw that with the stock market.
So both from the fiscal policy and monetary policy, we're getting huge help from the government in trying to address things.
So I think this chart illustrates that really well. If you look to the right side, this is the PE ratio, the forward PE ratio according to JP Morgan on the S&P 500. We were around 18, 19, and then we had a dramatic fall, and then we had all that Fed support, and we're back up to 19. You could argue that's a little bit, over fair value. I think that we are within fair value range, but a little stretched right now. We'll get into that a little bit later. That chart's a good way of illustrating that. High yields. So this quarter, one of the takeaways is going to be we're going to remain underweight in stock, partly because of this chart. If you look here, we're looking at about a 5% earnings yield, which isn't very significant. For high yield, if you invest in high yield, which historically has about half as much volatility as the stock market, we're going to be getting about an 8+%. So all in, you could argue that high yield is less risky and more opportunistic than stocks right now, and that's part of the reason why we dipped our toe in really toward the tip of that peak. And why we took a bigger step in more recently as part of our quarterly rebalance.
So although this is a bond, we can think of it as having risk that's not unlike stocks, but less so than stocks. It's volatile potentially. The returns we might expect are similar to what we might get from stocks, but by doing it through this way, we have a little less exposure to risk, and this can present opportunity right now.
Yeah. So Chris, good point. I mean, the only reason we weren't in it before is because that risk-return trade-off just wasn't there at all. So we decided it wasn't a good idea prior to this sell-off. The money supply is very important. Mostly, the Federal Reserve typically controls the money supply, but fiscal policy also does that as well. Over the last 3 months, this is through 3/30. We had an 8.6% growth rate in the money supply, which is a 34% annual run rate. And quite frankly, it's significantly higher than that. And why do I care about that? It's because if you increase the supply of something, generally you decrease the value of it. That doesn't necessarily mean we're going to have inflation. That's a different story if you want to talk about that at some other point. But it does likely mean that gold will do well. Which is one of the reasons why most everybody in our client universe has a good portion of gold or some exposure to it. So, you know, on the next slide, I'm comparing that 34% run rate to the 2019 growth rate of 6%. And quite frankly, 6% is a historically pretty big growth rate itself. So we're having unprecedented growth in the money supply. You know, a good way of thinking about this is you can essentially create dollars out of thin air by buying financial assets, but you have to mine gold from the ground. So, you know, the supply of dollars can really outstrip the supply of gold really quickly. So I want to talk about tax-exempt bonds for a second. You know, I mentioned towards the front that a big mid-quarter adjustment we made was buying tax-exempt bonds. So if you see VTEB in your portfolio, those are the Vanguard tax-exempt bonds. Part of the reason why we wanted to buy this, and we bought it at 47.41, it's trading at about 53.59 today. When I put this together, it's probably about the same ballpark today. I don't have it in front of me right now. Part of the reason why we bought this was because these are AAA rated generally. I do understand that you could probably throw that out since they make they're going to lose a lot of their tax income. But this is going to be supported by the Federal Reserve. So they've already come out and said that they're going to be buying this paper between 0 and 2 years. So even the most stretched state credits for sure which have balanced budgets amendments in the Constitution will likely be their bonds will be bought and they'll be able to refinance even under the worst case scenarios, I believe. In addition to that, the government's going to have create fiscal funding. When the government creates fiscal funding, it creates an equity barrier for the states, which allows the Federal Reserve to lend on top of that. So it's actually exponential amounts of liquidity for the bonds. You know, Mitch McConnell made headlines by saying he'd allow states to go bankrupt. Right now, it's not constitutionally legal, so they would need an amendment. So I'm not necessarily concerned about that. I'm also not concerned that they need to go bankrupt, even Illinois and New York.
And just to back up, so this was, I think, something we want to highlight as one of the moves that happened within our portfolios. Oftentimes people ask, you know, how are we reacting to market conditions? What have we done? And, you know, are we being opportunistic or are we being defensive? And, you know, this is one of those instances where we look at the way we worked into the quarter and the way the portfolio played out over the quarter. We were, by and large, modestly defensive, pretty good exposure with things like gold and the way our bonds were positioned and the level of equity exposure, a little underweight. But then during the quarter, some of these changes created some real opportunities, and to, you know, compliment Brian for identifying these opportunities. In the case of the tax-exempt bonds, in the case of the high-yield bonds, significant price displacement happened when there was the height of the anxieties of the market being in disruption. And because of this anticipation of the likelihood that the Fed was going to have some role in backstopping these kinds of investments, it mitigates some of the risk. And even to the point, Brian, would like for you to just touch on the notion of how you've used tax-exempt bonds, even in an unlikely location that we don't ordinarily think of having tax-exempt bonds.
Yeah, most people wouldn't put them in IRAs and IRAs because they're tax-exempt anyway, so you don't get the tax benefit. We're doing that because there's a significant dislocation in the price. You know, a comparable Treasury bonds yielding about 0.5%, where these bonds are paying about 2.2%. So, you know, you might say, Brian, it's a difference of 1.7%. Who cares? Well, I care because typically these trade for a lesser amount than a comparable Treasury because they're tax exempt. So if the market were to correct to historic levels, then we should expect a 1.5% rally in this at least.
And the price of the, yeah.
Times 5, right? So you can expect 7 to 8% in gain. So I'd like to pick up that 7% 7 to 8% gain in my tax deferred accounts as well. It makes logical sense to me. And at the same time, I'm going to get paid a higher yield. So, in this, I might go the rest of my life without doing this again, to be quite honest.
Yeah.
I do think this is an extremely unique circumstance, but in this situation, it makes sense for everybody. Another thing that we did was we bought long-dated Treasury bonds. So, during the liquidity crisis, literally every single asset sold off, and even Treasuries did at one point. It was really fantastical because there's no doubt in any market participant's mind that the Fed was going to come in and buy long-dated Treasury bonds. It's the playbook. It happened in the Great Depression, happened in the Great Recession. There was no doubt it was happening again. We were able to get in there and take advantage of that severe price dislocation. We are since out of it because the market has recovered to the point where I just don't believe there's very much more upside there. Very much upside, as opposed to being in the tax-exempt bonds where I still think there's upside.
Hey, Brian, before you transition, while we're talking and continuing on with the remainder of the presentation, which is pretty far along at this point, I want to encourage anyone who does have a question that they'd like to ask, be aware that on your panel there is a Q&A option that you could type in a question if you'd like to be recognized for a question, in addition to those who submitted questions by email in advance of our presentation. So if you have a question, certainly now's a good time to start thinking of submitting that through the dashboard. Thanks.
So forward thinking, again, we don't just want to be reactive, we want to be proactive. We want to be ahead of the next risk. We want to take advantage of the next opportunity. Just like we did, by taking advantage of the opportunity that presented itself in gold and avoiding the risk of being overweight in equities going into the quarter. So, these types of things help us identify risk before they happen, so we don't need to be reactive. We didn't need to buy more healthcare stocks because we were already in them at a better price. Another good example. So what am I worried about? I'm worried about the European debt and the financial situation over there. And why? Well, it's the European Union is similar but different than the United States in that they all run basically their own fiscal policy, but they all rely on the ECB for monetary policy. And this can create, significant political problems for one, and B, some real economic problems and some moral hazard debates. We saw this in 2011, 2012, 2013 with the Greece issue. And it's really unclear how the ECB is going to react. The ideal situation for an investor would be that the ECB would continue to buy up the bonds of the fiscally irresponsible countries to keep their to allow them to continue to access the capital markets, much like the Fed is going to do with the municipal bonds and states. It's just unclear if the member states will allow that to happen. Most notably Germany. Germany has a cultural and political force that forces them to basically run a balanced budget within 1 to 2% of 1 to 2% deficits. So they don't really have a lot of sympathy for the pig states. Christine Lagarde, so far, her actions have been to buy bonds, and relieve those countries. Christine Lagarde's the head of the ECB. And but her statements have suggested otherwise. So it's interesting how that will play out. Needless to say, it's concerning to me, and it's one of the reasons why we're going to be getting out of our European-centric funds.
And so we will diminish some of our European or our foreign exposure in the process.
Yeah. So when the next couple slides are really going to be about stock market valuation. So we think nobody knows whether it's going to be a V-shaped or U-shaped or an L-shaped recovery. V-shaped being the economic conditions fall quickly, snap back quickly. It's possible, if we get a great treatment where people don't need to worry about dying from the coronavirus, you can kind of quickly imagine, the world going back to how we were previously, with a nice snapback. There's evidence for this. I don't think it's not really 100% expected for sure, but if you look at the manufacturing PMIs for China, it really appears that happened to some degree. So yeah, if you can see that chart, the blue line is the line that market participants are seeing, and the red line is the official one from China. So it's good to have both, because sometimes people don't believe the Chinese statistics. South Korea is having, kind of similar results. They did well with the virus, but they're not snapping back quite as quickly. But they're doing, well. So it's a little bit more evidence for maybe a U-shaped recovery. And all these things are important because you need to probability weight all three scenarios of V, a U, and an L when coming up with a range of expected valuations for the market. An L shape, I think everybody can imagine what an L shape looks like, right? People are a little nervous to go back to restaurants or go to the movie theater. People are a little bit more skittish about going to grocery stores or anywhere with a lot of people when it takes a little time to come back. Chris, I know that you like to talk about this, possibility.
Well, I'm more in line with the notion of a U-shape, but the concern is very valid that, will this have prolonged impact in changes in behavior? And I think Mike has typically articulated that view best among us. And then I do think that, one of the things that, I'm inclined to think that it makes it harder for a U-shaped recovery is that there's this lagging consequence for purchasing behaviors because of people being behind on mortgages or credit cards or whatever it might be in this period of time when there's so many people that either because of their business being closed or their job being foregone, that they may not have the opportunity to rebound quite so quickly. Will their job come back right away? Or will it be a longer process in that endeavor? So, in all likelihood, we might expect something that's a little longer, but we want to be positioning the portfolio, very challenging to do, to be poised for any of these possibilities. And so, Brian, you've done a good job in trying to think about what should valuations realistically be looking like. And therefore, how should we think about where we are at the current levels of the market? Let's say, for example, the Standard & Poor's 500.
So when you, in probability weight these things, which is important, nobody knows for sure which one of these things is going to happen. And, the market's probability weighting these things as well. And you need a wide range because any of these things can move the market pretty quickly, as we've seen, or any kind of change in the probability can change the market. And we have a pretty wide range, right? So we expect somewhere between 2,400 and 3,000 is our range for fair value. So what does that mean? I mean, that means if it was below 2,400, I would be extremely bullish because I would say the market's really cheap, right? And if it was above 3,000, I would be much more cautious because I'd say the market's very expensive. And then midpoint's 2,700. We're at 2,800 today. So like you saw on that JP Morgan slide, I'd say that we're pretty relatively expensive to the midpoint fair value. Market's certainly not cheap anymore. When it was at 2,400, I wanted to come up with new strategies and get more aggressive, and the market corrected me real quick there, with the bounce back before you can really get too aggressive. But that's the kind of market we're in. We're in a liquidity crisis. We're no longer in a liquidity crisis. We're somewhere near fair value today.
So that's an important backdrop, and I think one of the things that comes up often is as I mentioned earlier, should we be opportunistic? Should we be, being more cautious? Should we change our strategy somehow? If you have that notion that we're somewhat in the right range where the market is trading presently for what seems realistic for fair value, which is based on discounted earnings, the likelihood that earnings aren't going to be as good as they were originally thought to be, and we've kind of taken that into account to come up with some of these numbers, then it helps to inform your thinking about how should we position the portfolio? What should we be doing that's different or in line with what we've been thinking about? And in the conversations I've been having with clients, I often like to take a moment to say, have you thought about what are some of the names that you own? And I think it can add a lot of confidence in saying, well, maybe I can ride this out, even if things do get a little more volatile, a little more dicey as we go forward. It would not be surprising if we see continued swings in market movement. But when you start to peel away the layers, most people don't know what's inside the different funds they own. They don't recognize the holdings. But when we look at some of the names, this is one of our client portfolios just a few weeks ago. That was the strategy for the 50-50 simple strategy. If we peel away the layers behind all the mutual funds and ETFs, these are some of the names that these clients and you may own. Things like Johnson & Johnson. Don't feel too worried about that right now. Microsoft. Just anecdotally, when we were going to have everybody working from home a month or so ago, we went out and bought a couple of computers, and what's the first thing we bought? Some Microsoft products to make sure that they could function properly at home. Samsung Electronics. So if I don't have an Apple iPhone, I probably have a Galaxy, and that's a Samsung product. If I have an Apple product, again, they have some supply chain issues that could temporarily create some challenges, perhaps. But are people going to stop buying Apple products? It might be some temporary disruption, but can they weather that storm? Will they come back strong? Very likely. United Healthcare and so forth. You can go down this list and see there's just a lot of names that, as an investor, as an owner of these companies, by and large, you can feel a high degree of confidence that these companies are going to be around for a long time. And even though we might see some volatility, that the kind of names you'd probably want to own and might want to be buying, not selling. So let's talk a little about some economic tactical considerations.
So we were in EMLP, which, if you're familiar with the oil and gas industry, is historically one of the safest parts of the oil and gas industry. Typically, as the further you get down the supply line, the less risky it gets. And these are essentially toll collectors, right? Now, these stocks that we have in the
just to explain what that means, the toll collectors, I understand it, but essentially oil and gas flowing through these pipelines.
As the oil flows through the pipelines, the pipeline owners get paid as oil flows through, just like a car would flow through a highway. The state gets paid by the toll collector.
Thank you.
So, basically the story is that if oil is down for many years, this will eventually get affected. The stock market reacted to it very quickly and sold it off. Now, I spent a lot of time looking at it and deciding whether we wanted to continue with the EMLP as part of the economic tactical, because we had bought it as a utility replacement because the yield was frankly better. And I basically weighed it against owning more of healthcare. And so we were already in healthcare. Many clients are asking why we weren't buying healthcare companies opportunistically. The answer was we already owned it. It was only a matter of, do we want to buy more of it? And I honestly wanted to stew on it for a while. We were doing very well with XLV, and even XLV combined with EMLP did what we expected it to do. It lowered the volatility of the overall portfolio. So I weighed the option of reinvesting in the losses of EMLP, because I do think over time it will recover versus riding this component of portfolios just with healthcare. And ultimately, I decided that healthcare, although it had done well, still wasn't overvalued by any stretch of the imagination. There's still a lot of opportunity in a lot of these places. And part of the reason for that was, quite frankly, people concerned about changes in healthcare policy. So I just decided that we decided together that it would probably be better to be all in healthcare rather than healthcare and the MLP business. And this is a great chart from Fidelity, which helps explain where you are in the economic cycle and which sectors tend to do better. And there's just no doubt that in this type of environment, healthcare will do well. Based on historic assumptions and just using common sense. I mean, we're in a virus state, right? So, that's why we really decided to go for it.
Hey, Brian, before we continue on, I know it's going to be something we talk about briefly in the questions, but we can kind of address it now. The issue of whether to own certain biotech names or names that could benefit from how things are working with the coronavirus. Since we're talking about healthcare, do you mind just touching on that and elaborating on why we feel that we've got some great options currently already in the portfolio?
Yeah, I mean, I can, any vaccine testing or a treatment candidate that you can think of is highly represented in this portfolio, unless it's something obscure. So the big names are all in here. And I think it's really best not to try to pick a winner or a loser. Who's going to find the treatment first? Because as far as I can tell, even the doctors don't know which one's going to come ahead. I mean, Gilead's drug was featured prominently. Now, not so much. So, owning a little bit of all of them.
Yeah, and the testing, you've got representation even in the testing as well.
Yep, we got Abbott Labs in there. So, just because you don't see the specific name doesn't mean you don't own it. You own it.
So something good for people to be aware of.
Chris, I think you wanted to address these slides, right?
Well, getting back to normal, we will over time be getting back to normal. And as we think about if we weren't in the midst of this coronavirus, what would we be talking about? Clearly, the political dynamics of the year ahead of us. We've got the national elections for the presidential election in particular coming up in the fall. And naturally, that's something we'll want to have continue to be on the radar. By and large, our base case thinking right now is that if it seems likely, as current polling suggests, which can change, but as it seems right now, it appears that neither the House nor the Senate will change control from the political party that controls them. And if that's the case, we've got essentially some divided government. And so, it's anybody's guess what's going to happen in a presidential election at this point. So irrespective to some extent of which party wins the White House, if we do continue to think there's going to be divided government, markets generally tend to be at ease with the notion of divided government because nothing radical can change. And so our expectation is not one where we need to presently be focused on making dynamic changes to the portfolio on the basis of the political environment today. That's something we continue to watch and will continue to be attentive to. But given the current environment, it's okay for it to maybe take a little bit of a backseat. When it comes to the global macro landscape, we do recognize that we've had some benefits still from the resolution of the phase one with the China arrangement and tariffs being not accelerated the way they might have been otherwise. And Brian, maybe you want to comment on this, but the notion that you had mentioned the idea that, if we really needed an economic boost, there might be the opportunity to think about how we think about tariffs right now.
I think it's a lever to pull. I don't know if there's the political will to do it from the president. but it would certainly put a boost into the stock market, at least temporarily. And I do think that there is a motivation to do that. So I wouldn't be surprised if we saw some, some changes in the tariff policy going forward.
So we'll keep an eye on that as well, and that could have some impact.
Not expecting
What's that? Yeah, not expecting it. It's an
but I wouldn't be
outside
surprised.
possibility.
Yeah.
All right. So takeaways. Brian, why don't you just continue? You're doing a great job.
So, markets at fair value. We're going to continue to underweight equity as we have been, but we're going to offset that underweight with some high yield, just because we think it represents some better risk reward at this point. As far as our individual stocks go, we were in low volatility components. Moving into this was also helped with our performance. I don't even know if we mentioned that. And we're gonna remove that. We're gonna add growth, and the reason for that is the dramatic change in interest rates and money supply. Growth tends to do better when their future cash flows are discounted at a lower rate. The European financial markets have been cause for concern, so I mentioned that we're going to eliminate the European specific funds. One other thing that I don't think's in here is we're going to continue to ride the back of the Vanguard tax exempt bonds that I spoke about earlier, where I said that we were going to remove the longer dated Treasury.
And in some respects, there may be some modest increase in gold. At least we're keeping that pretty heavily as to the extent that we have it, we're keeping that in the portfolio right now.
So the proportion of gold to your portfolio rose over the quarter because gold did well, where other things necessarily did not. And we weren't really looking forward to selling any of it. So we kept, we're keeping it and maybe buying modestly more. So here's some submitted questions, Chris.
Yeah, so let's go through some of the questions that we did receive. Thank you for those who sent emails with questions, some great questions that came out of that. Again, if anyone does have questions now, you could either type in your question in the Q&A area, or you could raise your hand if you want to have the opportunity to verbalize your question. So we had one question that dealt with China, and the concern was the idea that there's a lot of talk about boycotting China as a consequence of certainly the current state we're in with some of the virus having emanated from China. And could this time be different and lasting? And if so, what impact might this have on the economy? And couldn't things made in China be made here or in other countries? If that happened, what segments would benefit or be adversely impacted? So, this is a good question, and there's a lot of uncertainty right now as to what extent will this really play out. I have my doubts about the long-term expectations for some kind of boycott really taking impact. And the reason I say that is we've had for many years now the notion that people could be buying American. And what do consumers generally choose to do? They tend to choose to buy what's cheaper. And so I expect that trend will likely continue, that people will be more inclined to want to buy things based on price than they will on its origin. Now, could that change for a time? It might. There has been a move away from, the virtues of free trade, a focus on the challenges of free trade. And so it's very possible that that could be viable, but I just am not expecting it. Brian, you had also mentioned there might be some logistical realities that make that very challenging to even entertain because of where stuff is made that are U.S. companies.
Well, first, it's just hard to move your supply chain. And second, what are you really boycotting, right? So Nike designs, does everything for their products except manufacture in the United States. So are you going to boycott Nike, or are you going to boycott just products that are designed, marketed, and manufactured in China? I think it's a hairy situation, to even think about where to start and where to end.
But so the bottom line for us, I would say, is this is not currently a major factor in our thought process about where we're investing. That being said, we are underweight international exposure for companies that are domiciled outside of the United States, they are a more modest part of our portfolio and getting less so this quarter compared to last quarter when we were also underweight international, but that's not specific to China. In a couple of our strategies, we do have a China-specific fund, which Brian, I imagine that's had a pretty good bounce back as a result of some of the changes you mentioned in the economic content.
Yeah, it's outperformed the domestic market.
Another question we had was from a retired couple who said, you know, they were appreciative for the way the portfolio had reacted, hadn't gone down as much as the market, and they were pleased by that. But they have these split concerns. On the one hand, what is the reasoning behind staying invested to regain a small percentage lost while risking losing the investment's total? In other words, why might it be wise to stay invested in this downtime with conservative investments and at this point relatively modest losses when the future could result in much greater loss of principal, is the concern looking forward as we look ahead. So why not put that money into something more conservative like a money market or something where we can sidestep some of these risks? And so, and we'll come back to the other question in just a second, one question at a time on this. The first thing I would say on this is that, you know, time horizon is really essential. You know, time horizon, not timing. If we're thinking at least of the portfolio, a portion of the portfolio or its investments in terms of years for investing, then we can weather the storm. As we just talked about, some of the companies are great companies that we want to own for the long term. We've seen the portfolio demonstrate an ability to hold up relatively well. And it is very difficult to try to time markets to move in and out and tactically that way. And because ultimately, most times you're looking backward and something's already happened in the process. So, you know, I think just in the last month, we could look at that example. A month ago, who among us wouldn't have been thinking, maybe we should sell some stuff? Markets had dropped drastically. It was just a time of great anxiety. And if we had pulled that money out of the market, well, let's face it, we'd have missed out on some of the rebound over the last couple of weeks. Now, is it possible markets will go down? In fact, it's very possible, almost probable. We will continue to see some volatility, but to what degree? And ultimately, how might it, you know, rebound? We've kind of made the analogy to the road. You know, we're on a road and driving, and we can see there's a dip, but we can also see that if we get to the other side at some point, it's going to crest back up. And that's the way we might want to think about our portfolio. I heard that analogy from somebody else, and I thought it was very apt. What we can't see exactly is how far down the slope and the extent to which it goes down, but we do know we'll get to the other side eventually. So, and I think one last thought on this is the financial planning context. If you don't have cash reserves elsewhere, if there is not any liquidity, then it becomes a different calculation, and we might need to really think about scaling back risk if there's not sufficient funds to meet one's needs. But as was indicated earlier, that's not really the case in this couple's scenario. So you probably have the ability to ride things out, I think, and weather the storm, so to speak. And I think that's the benefit is really by holding tight, you're going to have more upside than you might miss out on by moving out of the potential bumps that we might still have. And you might not get the benefit of recovery that we otherwise might have. The other question that this couple had was, what opportunities might there be? As an investment firm, what are you currently doing about buying opportunities on sale now? What how does this work for all your clients, given different levels of risk tolerance, which is also a great question because it is a reality that different strategies will have different response. But we've talked a little bit about this throughout the presentation, that whether it's through some of the ways we've responded to opportunities during the quarter, high yield, treasuries, munis, gold, shift toward growth, all these things are things we've done or are doing in response to where there's opportunity. So we certainly are being more opportunistic in the way we handle the ETF and mutual fund strategies, in the light of what we're doing in those strategies. Brian, perhaps you want to just touch on the individual stock strategies that we handle as well, to identify where there's opportunities being identified there also.
Yeah, so the individual stock strategy, is obviously more dynamic. So, individual stocks move faster and more volatile than in the entire market. So from the ETF mutual fund side, we're usually thinking of macro asset calls. What can we make from that positioning? From the individual stock, it's you can see violent moves pretty quickly, and a stock that wasn't on your radar because it was just far too expensive could all of a sudden be an opportunity to buy and hold something for the next 10 years. If you get lucky, if you get your price. And we certainly had those opportunities. I mean, we were buying things like, the first thing we did was, one of the first things we did was we got out of our speculative stocks just because there was no reason to try to shoot the lights out when you had so many other opportunities. I mean, there was manna from heaven, really, from somebody who likes to pick stocks. But some of the things that I was really, happy about was like picking up Visa in the 130s. This is multiple years that we're never going to see that again, I don't think. We got outsized yields from companies with solid balance sheets, or companies that can certainly raise money, or companies, severely great growth companies like, Facebook in the 160s, 170s, which is unbelievable steal. So it created a lot of opportunities to take advantage of there. And for the most part, our clients' bond portfolios held up. So we were first of all, we were in a lot of cash. So I was able to invest the cash. But second of all, when you really wanted to pull the trigger on something, you could draw down from some of the bond funds that were there and keep your risk position proportional.
So thank you. One of the other things that I want to come back to was the idea of how do you think about the different risk profiles and how we think about how to address that. And I think the best answer to that is that we think thematically. And although the percentages and the weights will differ from one strategy and risk profile to another, the themes may be resonant throughout our different strategies, throughout our simple strategies, our ETF mutual fund strategies. For example, we've put an emphasis on healthcare. We have moved away from the low volatility names to more growth names. We've moved out of things like energy and utilities and so forth at this time. So the emphasis on the things we talked about in doing seeking opportunities in fixed income, the gold. Brian, do you want to just touch on that at all, or do you think that covers it for the thematic kind of notion of this?
I think you hit it, Chris. I mean, if we make a tactical change, it's going to be more highly representative and it's a conservative investment. It's going to be more highly representative in the conservative portfolios. And if we make a more aggressive change, it's going to be more highly representative in the aggressive portfolios. But the themes are all the same.
And whereas in the individual stock portfolios, you can be more targeted, not strictly thematic, as we try to be with the ETF and mutual fund designs.
Right. But even then, I'm not going to buy a stock just because it's in the news. I think we get a lot of emails like that, so I think it's an important point. If it's in the news, it's probably already too expensive. I could think of one situation where I bought Regeneron, which is working on an antiviral a drug with the antibodies. It's in the news a lot. But I actually looked at that stock and thought it was an amazing value anyways, because of their other drugs, where maybe with the Gilead Sciences, which was working on remdesivir, I didn't feel that way because, their Hep C customers are dwindling, and their AIDS drugs growth isn't growing as quickly as you would like. So, you know, where I didn't want to buy Gilead, I wanted to buy Regeneron, and, you know, that's a decision that you can make.
So you can be more selective and more refined in the way you apply the themes. Maybe.
Right. Price matters.
We had another question about, should I hold additional savings for liquidity in case I get laid off, or invest opportunistically in a Roth IRA while markets have declined? And I think this is a great question, very challenging, because we have both impulses we want to do. And my thought is really to be a little more defensive. If there's a chance someone might be laid off, we probably want to be building up that reserve and have liquidity be the paramount priority, as compared to being opportunistic in the Roth IRA, where we might not be able to get access to the funds as readily. We had another question, Brian, that related to IBM and the use of a new microchip technology that they had heard about could be potentially impactful for the stock. And should this present renewed enthusiasm for the holding? Perhaps, you know, I'll offer a couple of thoughts before you do, but maybe you'll want to comment on that. One of the things that I would say is the reason ultimately, in many accounts, we want to think about the challenge of over-concentration. Many people have, for the history of whatever reason, they've had an abundance of a particular name. And it's not really about whether that company is a great company or not. Many cases, they are great companies. But we ultimately don't want too much concentration. In the case of IBM, another, it's Procter & Gamble. Another, it might be SiriusXM, Lockheed Martin, AT&T, whatever it might be, another and another and another. These are things we see routinely with people that, for whatever reason, because of the legacy has been there, and that emphasis on a given name, if it's greater than 5% generally, we're uncomfortable with that in the portfolio because it takes on more risk than we might want in the individual name. And so we want the benefits of diversity. Rule number one, diversity, right? And so, you know, there are other ways we can deal with it. If we can't sell the stock because of tax consequences, we can think about option strategies, which may give us the opportunity to have an element of insurance. But either way, whether it's taxation or insurance, if you will, there's a cost, there's a premium, and it comes with a cost, and it's not inconsequential. So I think each individual situation needs to be examined on its own merits, but by and large, that's the driver more than anything else. Now, maybe, Brian, could you speak specifically to this consideration about IBM?
Yeah, sure. I want to use it as an opportunity to explain to people a little bit about how we think of stocks, not just IBM, but all stocks. So I pulled up my notes, my most recent notes on IBM, which granted is getting a little dated. I did this on February 13th. So just perspective, their CEO, red flag to me. And in fact, he's not even the guy I would have picked. You know, they seem to be insistent on being an old stodgy company rather than a tech company, which is what they are. So that's something to keep an eye on. People might love it because they have a good dividend yield, right? 4.17%. But their revenues are declining. The gross margins are declining. Their operating margins are fine, and their return on investment, quite frankly, is mediocre for the total market and kind of stinks for a tech company. You know, they don't really have any room to grow their dividend. This was done before the Corona nightmare. You know, I expect them to make between $7 and $8 billion this year over the next 12 months, and they pay out, you know, over $8 billion in capital returns. So if anything, I would have expected a cut. So, you know, when I did this, the stock was trading at 154. I just looked it up. It's trading at 125. My price target on it was 80 at the time. So the fundamentals of it just don't add up to being a stock that I would really want to be involved in.
Okay, so we have one more question, and then we have a question at least that's been submitted during the presentation. So one other thing that I had received recently, not sure if it was specifically intended for the seminar, the webinar here, but what are the best current opportunities once identified, when to invest? So I think we've talked a little bit about where we're seeing opportunities and how we deal with those in terms of our timing. Generally, it's through our quarterly process, but in the case this time when there are great opportunities, we jumped on them. Should I be looking to do a Roth conversion or a backdoor Roth IRA contribution? Maybe we touched on that briefly, but we will talk about these concepts in more detail in next month's seminar for anyone else. But I think in the interest of time, I'll speak to those directly to the client. Does index fund use make sense? And I think that's worth talking about briefly. In our strategies, we do use index funds, but we also use managed funds. And at different times, there can be virtues to both. For you, our investors, we play the role many times of the benefit of what a manager could bring. And so we try to keep those costs a little lower with the use of indexing. But oftentimes we make strategic decisions about where there's opportunity and where we should bring in more defensive positioning. And so we do tinker with the portfolio as a way to give you the benefit of what you might get in a mutual fund at less cost with the use of an index fund. So you get some of the benefits of both. And then should I stay put or without changes? And I think it's important to remember that our active allocation process does make changes. We are actively making adjustments each quarter. And the last question was about real estate. Brian, would you care to weigh in on what some of the concerns people might have about real estate these days?
Well, all real estate isn't the same. Real estate in general is taking a whack because people are concerned about people not paying their rent, both on a commercial, both commercial side and residential side. But what do I mean by it's not all the same? Well, I do think there's a difference between owning a tenement building, an apartment building, or owning real estate in New York, in Manhattan, versus owning a warehouse facility, industrial warehouse facility, or a mall. They all have different pros and cons, and given their price at any given time, they can be opportunistic or not. I can tell you that in the individual stock portfolio, we do own Simon Property Group. The reason why is because Simon Property Group owns a bunch of malls, if you're not familiar with it. So, part of the reason is because their real estate is worth far more than the company's worth. So I do believe there's a margin of safety there, which the reason why they're never going to have a liquidity problem. So, little things like that can make a big difference. So it's not really made the same. Industrial warehouses are hot right now, right? Because we need them for logistical purposes to get packages to people's homes. Commercial real estate's definitely under the thumb right now because people are really wondering if it gets really comfortable with Zoom, if they're going to go back to their office. I think there's some legitimate questions here, and I really think that you need to dig deep to make any significant changes. The only real estate fund that we have is part of the dividend strategy, and I think it is a core holding in the dividend strategy, and it's actively managed. And the reason why we choose active management in that space is because it's it's such a complicated space.
Great, thank you. We have one question that came in the Q&A section from Mark, and he asks, do you see opportunities for companies involved with advancing 5G tech environments? And this has been a question that we've gotten a lot over the last year, I'd say, from various investors. And maybe it would be worth starting with, how do we have that represented in our ETF portfolios, and as well as, do you see that as something that's particularly attractive?
Sure. So let's talk about what it is, right? It's basically an infrastructure that's going to give you Wi-Fi capability through a cellular network is essentially what it is, right? So you're going to have
faster transmission of data.
Yeah. So what's going to benefit? Well, it's going to help you stream data better. It's going to help, workflows better. It's going to make so you don't necessarily need a hard drive anywhere because you're going to be able to download everything from the cloud. So the short answer is yes. I mean, of course, we're heavily represented. Representative. I'll talk to the individual stock portfolio because I think that's just a good way to do it. Suffice it to say that if you're in an ETF mutual fund strategy, every single one of these companies are in your portfolio, and even more heavily representative this quarter than it was last quarter because we moved to the Nasdaq 100 from the low volatility fund. But I've really liked Broadcom, which makes the semiconductors that help make things like that possible. I like Xilinx, which makes a more sophisticated semiconductor where you can actually make software upgrades without needing to replace your chips from a year-to-year basis. We like AT&T at 29 times at a price of 29. It's obviously a cellular network, but they also own an entertainment company in Time Warner. And they're actively trying to marry those two under the thesis of the 5G revolution. And there's other examples too. You could certainly point to Apple and Samsung, which we pointed out was heavily represented in a lot of portfolios. But yeah, it's in there. Sometimes it's not obvious. Sometimes I think people want an ETF that's called 5 or something like that. Usually that gives you an unnecessary concentration. There's going to be winners and losers. Again, price matters. So if you want to get more specific, you should probably maybe dip into the individual stock portfolio, or suffice it to say that they're in your ETF mutual fund allocations.
All right, very good. I think that does it for our questions at this time. We've run a little longer than we had hoped, but I hope that a lot of these questions have been helpful for others as well. Brian, I don't know if there was any concluding comments that you had prepared, but I'd like to sort of wrap things up and give some parting thoughts.
That's it, Chris, from me.
Okay, so what does this mean? So it's a challenging time. So there's no question about it, and it's very possible it will continue to be. We were talking over lunch today with the family, as we're all here at home, and the notion that a little bit of isolation fatigue as we're here. We're past the beginning of this, but we're not at the end of this, and it makes it a little bit challenging. And when we think about not only the healthcare part of this, but the economic and market aspects of this, it's going to take a while. And so as we look ahead over the course of this year, it's very likely we're going to have some bad economic data that's going to come through, and it's going to be a little bit stressful at times still. But when we take into account the broad efforts coming from the government in the form of the Fed and the Congress and legislation that's being signed into law by the president, we do have some real help in this process to mitigate some of the impact. And we hope that will help a lot of the challenge of this be softened a bit. So it might not be quite as dramatic. If this continues to be something that these isolation policies will last much longer than we expect, that will have some economic consequence. And Brian has talked about how we've thought about these valuation considerations and how that's factored into our strategy and the way we've designed the portfolios. So as an investor, one, it's important that you have liquidity. We talk about buckets often, and the notion of having some money in the bank or a place to have reserves. If you don't, it might be worth a conversation to think about, is it reasonable to entertain some changes in your strategy? Think about risk. We've sent out an email a couple weeks back now where we invited anyone to take a risk survey again to evaluate their risk profile. In case they are uncomfortable, we can review whether it makes sense to change things or not. Let's face it, we had a long run up over the last 10 years or more, And yes, we've seen things go down, but they have bounced a bit. So it's not unreasonable if your circumstances suggest that you need some liquidity or you have worries about how things may play out. Let's talk about it. We're here to help with that. And so, we have been putting our attention to the strategies. We continue to be thoughtful about how to position the portfolio looking ahead. We generally are optimistic as to where we might see things go over the next couple of years. It may take some time, but we think that you're positioned well to benefit from that over time. The key thing is, if you have any concerns, let us know. We want to be available to you to talk about any challenges you might be concerned about. So I think that's a good place to wrap it up. Brian, thanks for all your hard work in presenting today. And if anyone has questions, you can reach us. Although we're working from home, our phone number does still work, and it comes through to Kristen's phone, receiving all our office telephone calls, 508-771-8900 for the Hyannis clientele. For those who work with Mike, you can call Mike's office and it will still be reached. And we're happy to be of help to you in either instance. So let us know if we can be of help, and thank you for the trust you place in us each and every day. So with that, I think we'll wrap it up. Thanks, Brian.
Thank you.